160 please on those.
Okay. Cheap.
Okay, I'll charge you more.
Good price.
Not far from some of the huge financial companies that buy and sell and pay millions is a much more modest market.
Madam, can I take you with a cherry? These ones are slightly sweeter because they're free. All about the philosophy sake.
The farmers' market in London's Bloomsbury is a small, rather more humble reminder of the roots of our modern complex financial system. The traders here, many of whom grow their own produce, share the same problems as farmers have done down the centuries.
I'm Nathan Ryland and I work for Wild Country Organics. You don't know how much you're going to sell, especially what we do with the organic. We just use water. So if you get a disease that suddenly wipes out a third of your cucumber crop, which you're relying on, then suddenly some random bugs will come and have a feast, and you're like, thanks.
And if it's a bonanza year, if it's a fantastic growing year, it's likely your competitors will have a similarly wonderful time.
Exactly. It's bonanza. So will a glutton of produce in the market reduce prices? You know, human nature, that's scarcity and demand and supply and all that.
Out of this uncertainty was born the derivative, now a huge part of how financial institutions make money. Terry Duhon, who designed derivatives for the investment bank JP Morgan, explains the simplest variety, the seed from which an enormous crop has grown, known as the futures contract.
Some form or another of those have been around for a very, very long time. You've got a crop, you want to be able to sell it, you need cash today, but the crop isn't ready to actually cut and send to market, so you sell it forward. You sell it ahead of time so that you can get the cash today in order to fund some of the machinery that you're going to need to harvest it, for example. That's a derivative.
So that's the most basic derivative, a futures contract. A variation on this is called the option. That is the right to buy or sell at a certain price. As the name suggests, it's an option rather than a compulsion. I suppose we can best think of it as an insurance policy against adverse price movements. In the modern financial world, derivatives like options and futures are used to hedge, another agricultural term deployed by finance. And a hedge does the same job for a banker as it does for a farmer. It provides protection. You could, for example, hedge against interest rates rising. Trading in these products is incredibly lucrative for the bank, but sometimes extremely dangerous for the unwary.
Most of my business life, I've been able to work things out on the back of a piece of paper. Any kind of property deals, I won't try and make them work. If they don't work out very, very simply, if my 10-year-old couldn't work it out, I won't bother.
Des O'Malley is a property investor and landlord with a very simple but effective business strategy. But Des found his simple business world turned into a nightmare of complexity when he took out a £1 million loan from his bank in 2007. Alongside this, he was sold a derivative. It was something called an interest rate swap, where he in effect swapped a variable interest rate for a fixed one. The bank said it was to protect him against a rise in interest rates. Actually, he was entering a bet which would see him paying more if interest rates went down. Des says the banker who sold it to him just wasn't clear about what he was buying.
He called it a hedge.
What did you think a hedge was?
To be honest with you, something at the bottom of your garden. I really didn't know what a hedge was.
And so what you ended up with, we are told, you found out subsequently, was a sort of interest rate swap.
I ended up with a dual rate callable interest rate swap.
Oh, right. And that sounds pretty complex. And so when did you realise that there was something wrong with that?
2009, when interest rates went below 3.5%. That particular quarter, about 15 grand went out and I wasn't sure what it was.
£15,000 went out of your account?
Just went out of my account and I wasn't sure what it was for.
When the bank sold the derivative to Des, he says he was told it would protect him against rate rises, which, remember, back in 2007 looked like a real prospect. Actually, by buying the derivative, he was betting that interest rates would go up, and when they went down, he had to pay extra. What's more, this derivative could never have been a hedge on his loan because the loan was for 5 years and the derivative was for 10. It cost Des £260,000 to get out of the deal, more than 25% of the value of the initial loan.
To break away from the swap, I've had to refinance, I've had to take out extra loans to pay the break cost, and I was lucky because I had enough equity in the properties. Most of the equity is now gone, and I've had to refinance away on not great deals with the banks that were available 2 years ago.
The bank that sold Des his disastrous derivative was the RBS. They told us that although they couldn't comment on individual cases,
we have agreed with the Financial Conduct Authority that we will carry out a review of the sale of interest rate hedging products to applicable customers.
one question the FCA might want to look at is why people like Des were sold something they didn't understand and in any case wasn't suitable. Some banking insiders think they already know the answer and, well, it probably won't surprise you.
Because the profits to be made were so huge and there was really very little control over them, people were tempted to inevitably put people into complex structures they didn't understand, where they would make enormous profits.
Martin Barclay is a consultant with Vedanta Hedging, which helps people who were missold derivatives. We met in Canary Wharf, surrounded by the offices of the banks where these fiendishly confusing products were dreamt up. He describes one of his clients in a similar position to Des.
He had borrowed £1 million for 10 years, which he was repaying over 10 years. But this particular structure lasted for 10 years as well, but it wasn't reducing. So straight away he had too much protection, if you like.
So why was he sold this rather than the loan that he thought he was getting and thought he was asking for?
Well, this particular structure he was sold, the bank made nearly £55,000 straight away. Alternative ones, a simple swap, if there is such a thing, that's closer to a fixed rate loan, not identical, would have made the bank about £16,000. But a simple interest rate cap, which was probably the most suitable, would have made the bank only £10,000.
According to Martin, the problem here is that the banks stopped treating people as customers and more like opposing traders. A small business owner, however, can't possibly hope to match a huge multinational bank in negotiations. The bank is in control of the terms and the information. Often, says Martin Barclay, there's a huge knowledge imbalance. He knows because he used to be on the other side selling these products. And he remembers one bank where they even kept tabs on which customers were clued up.
The underlying markets can be unknown to most customers, they've never even heard of it. What would sometimes happen is sales pressure would be put on the client to close a deal by telling them the market was moving against them, when actually it could be moving in their favour, because you're relying on them for information.
What, you can't go away and check it yourself?
There are ways of doing it, and one of the banks I worked at, on their client database, they had in big letters written, client has screens, meaning the client actually knows what the market's doing. So obviously these tricks couldn't be played on those clients.
As well as bankers earning fees, financial traders love derivatives because they can be used to create vast bets that only require a small upfront payment. When the bets pay off, the returns can be huge, but when they go sour, the impact on even a huge established company can be devastating. Losing derivative bets is what did for Lehman Brothers and the US insurance company AIG back in 2008.
My name is Paul Wilmot. I'm a mathematician and I've done quite a lot of different things within the finance arena, but all based upon the mathematics of risk management, derivatives, etc.
Paul Wilmot says the virtual world of derivative liabilities dwarfs the real economy.
We did research to find out what was the size of the derivatives market, and we came up with this. We discovered $1.2 quadrillion when the GDP of the planet is 50 trillion. That number, 1.2 quadrillion, that's 1 followed by 15 zeros. That's staggering, and it's very much a tail wagging the dog situation. The derivatives should be there to help businesses, not to be the business of the planet.
All the while, new derivatives are being created and traded 5 years on from the start of the financial crisis, and they're still getting banks into trouble.
Our top story this morning is about a JP Morgan trader they call the London Whale. What is a JP Morgan trader in London doing with positions as big as $100 billion?
Although this is how derivatives make the news, this isn't how banks usually deploy them to make money. Normally, they make most of their cash from running, not playing the game. They invent complex products and then sell them on in return for a fee. For the banks, this is a win-only bet. Shoreditch Das, the author of Extreme Money, explains.
Everybody in the world is trying to become a flow monster, which is you want to sit in the middle of all these capital flows and the flow of these transactions, and basically like a ticket collector collecting some fees. So you have party A wants to do X and party B wants to do the opposite. So the bank sits in the middle of those, and they would take out some small fees. The other source of revenue are what we call the structuring. So we create fancy products which the client might want. We can construct things which are not readily available. So it's not as if they can be easily seen in the market. They're not like shares. And obviously the banks charge for the bespoke tailoring that goes into it.
And there were some pretty large fees available for some of the more ingenious derivatives that the banks devised. As we know, the banks started creating lower quality derivatives from subprime home loans and even the debts of European governments. Shoredit Das says that for those governments, derivatives were really a handy way of hiding their debts.
There is a considerable degree of evidence that Italy and Greece fudged figures in the lead up to their entry into the single currency in the European Union. And they used these contracts to basically convert what would normally be debt into things which were off balance sheet and sometime into the future, enable them to actually lower their debt, enabling them to meet certain criteria for entrance. So effectively, what was a hedging tool has become very much more complex in its application. So I think rather than weapons of mass destruction, they might as well also be referred to as weapons of mass deception.
Indeed, the man who first talked about derivatives being weapons of mass destruction is Warren Buffett, widely acknowledged as the most successful investor of the past century. He told a US government inquiry that he realised how poisonous and deceptive derivatives can be when he bought a company, Gen Re, that owned 23,000 derivative contracts.
I could have hired the 50 smartest PhDs out of MIT to prepare some kind of report that would tell me the risk I was bearing, and I wouldn't have gotten the answer. I mean, it was impossible to get your mind around that.
The complexity of derivatives and the high returns has seen a power shift within the financial world away from the traditional economists or financial experts towards those PhD maths boffins that Warren Buffett was talking about there. Paul Wilmot is the type of maths expert that the finance world has turned to, but even he agrees that using complex maths to construct these finance models has gone too far.
People who work with these models, if they come from an applied maths background, like I come from, they will see these and think, they're a bit iffy, aren't they? A little bit dodgy. I take all these things with a pinch of salt. But if you come from an even worse field than finance, economics, and you see these finance things, you think Black-Scholes formulae, etc., they're fantastic.
Black-Scholes formulae. I think I must have been away when we did that one at school. If, like me, you think that sounds more like something to do with fish, well, perhaps you're half right. It certainly is a bit fishy. Believe it or not, when small business customers begged the banks for help in understanding just what they'd been sold, they were referred to these massively complex formulae. Remember our back-of-the-envelope property developer and landlord, Des O'Malley.
We were trying to get some kind of take on how this break cost was worked out, because at this stage I had no trust whatsoever in the RBS. I said to the guy, it's like me going to Tesco's and getting my weekly shop. I just want a breakdown of the bill. So he sent me a link.
So if we follow that link and go to the Wikipedia page, they say, which is to Black-Scholes. Okay, and what is this? So this formula is, well, basically it is like, and there's been an explosion in an algebra factory, hasn't it? If I had a month to study that, I would be, none the wiser, I don't think. What do you think?
No.
We have a world then where what's being bought and sold is so complex that only computers can follow what's going on. So it's perhaps a short step to say, well, if that's the case, why not get the computers to do the trading? Computers, of course, have another valuable attribute: speed. We've moved to the east end of London, right near Brick Lane, where people enjoy a curry and a night out. But where we're going is a very different world, and we've been really fortunate to get invited in here because we're going to see something that not many people see. We're going to see the architecture, the plumbing, if you like, of the modern financial world. And I mean, I don't know really what there's going to be to see, but I know what we're not going to see. We're not going to see those old pictures you can imagine of traders in brightly coloured jackets waving their arms around, because this is all done with computers, and it's done at an amazing speed. We're about to go into the world of high frequency trading, and they're a little nervous, and there's plenty of security. I've already had to register my fingerprints with security here to try and get in. Okay, so sensor. Put my finger on there. Green light, sliding door. Try not to touch the glass, I've told. I've gone into a little pod. Hopefully the door will open and I'm through to the other side.
So those are all the cages where you would have computers located.
Emmanuel Kaja is the managing director of TMX Atrium, a company that provides the plumbing, if you like, for all this super fast trading to happen. Located here are servers for lots of trading companies that are plugged in to the exchanges. Through these wires pass the deals made on our behalf for our pension funds and investments.
We're into putting computers that have extremely high level of power so that they can compute really quickly. So just to give you an idea, the speed of the network is 10 gigabits per second. Correlate with your ADSL at home.
Your broadband.
Your broadband, exactly. You would have about 20 to 30 megabytes. So in every single one of those cables, at 10 gig, you would be able to download an high-definition movie every 8 seconds.
So, presuming they're not downloading movies, why do traders want this kind of speed and bandwidth? Well, one way high-frequency traders use super-fast computers is to sniff round the markets to identify price anomalies, imbalances of a fraction of a penny that may only last a fraction of a second.
One of the key aspects of the market is to identify a price. What's happening today is that a stock will trade on a number of venues. Because it trades on a number of venues, you naturally have differences of price in between the venues.
So it might trade in London at one price and New York at another
Absolutely.
price? Absolutely.
Right. One of the high-frequency trades that happens is what's called arbitrage. It would be a firm that would buy the stock in London at a lower price in order to sell it in New York at a higher price. Now, what that will do is naturally equilibrate the two markets. That's a very typical high-frequency strategy because you need to do that every time the market moves slightly one way or the other.
So in the old days, a merchant would notice that the grain price in Bristol was slightly higher than the grain price in London, and he'd buy his grain in London and drive it to Bristol.
Exactly. So we're doing exactly the same through computer and high-speed trading.
Emmanuel says these computers have benefited investors by bringing down the cost of trading, with so many jobs previously done by humans now done in a fraction of the time by the computers. Dave Lauer, though, isn't so sure. He's a former high-frequency trader and says the big institutional investors like pension funds pay a huge price.
It will cost them over the long run. As these pension funds and mutual funds increase their capital assets or reallocate and rebalance their capital assets, they have to go into the market and place very large orders. High-frequency trading and the systems that are providing liquidity in the market have become very sensitive to any large order that enters the market. And as soon as that happens, the prices move away. So whereas high-frequency trading will say, well, spreads are tight. You can buy or sell and just pay a penny. That penny is only there if you're buying or selling 100 shares or 200 shares. When you go and buy thousands of shares, those things move away from you very quickly, and you pay 3, 4, 5, 6 pennies, and that is a wealth transfer to electronic traders where it's not clear the service that they're providing in this context. And that wealth transfer, while it's not tremendous in the present, when you look at returns over time, it is a substantial erosion of returns over time. And that means when you retire and your pension fund starts paying out, you have less money to tap and less money for retirement.
But Emmanuel Kaja says pension funds don't really need to worry about high-frequency trading because, well, they're investing for the long term.
The way pension funds look at your investment is not something that is happening over the course of a millisecond. So yes, maybe a penny is taken here and there, but ultimately you're not hoping for your stock to move by a penny. That wouldn't give anywhere near the sort of income you're looking for at the end of your life. So it's really two different industries. One is looking at it on a very constrained timescale, and we're down to the day essentially. And the other is the industry is looking at the performance of a stock over years.
But some pension funds tell a very different story. Adrian Fitzpatrick is head of investment dealing at Kames Capital, managing assets of $54 billion, and now sees a big part of his professional life taken up trying to fight off attacks by high-frequency traders and protect his investors' money.
What high frequency is trying to do is game what I'm trying to put into the market, they're looking for large institutional orders so they can trade around it all the time. I'm jumping into shark-infested waters because they're looking to feed off the orders I'm generating. So I'm like the whale and the little feeder fish.
Once they sniff that you've got a big order, they want to get round those exchanges quicker than you in order to snap up shares and make you pay more for them.
Exactly. Say I want to trade a Swedish stock, and the initial trade I do is in London because that's where the market happens to be in that stock. Between London and Sweden, there's an 8 millisecond gap. They can actually cancel orders, and they can also jump in front of my order in that 8 milliseconds. So it's just phenomenally quick.
And remember, any money that the high-frequency trader makes comes out of the retirement income of the pension fund member. One of the concerns as more and more computers trade with each other is that we'll see much more market volatility as the high-frequency traders pile in to amplify small price movements.
It's like Terminator. Machines taking over.
That was a human trader's response to the so-called flash crash of May 2010, when $900 billion was wiped off the value of the US stock market in just 10 minutes, only for the market to bounce right back again. The UK government commissioned a report that concluded there was no evidence that high-frequency trading was increasing market volatility. Indeed, that report decided that, on balance, this kind of trading was broadly beneficial. But not everyone is convinced. John Kay conducted a separate review of equity markets for the government. His conclusion was that we need to redesign our financial system to incentivise long-term investment. High-speed computer trading, he says, is an indication of just how dysfunctional the markets have become.
I think high-frequency trading is plainly ridiculous and the world would be better off without it. But my conclusion is that high-frequency trading isn't a major part of the problem we have in the way markets work. In a sense, it's a symptom of a hyperactive trading-oriented culture rather than the underlying cause.
I suppose coming back to your overarching theme about short-termism, you can't get more short-term than a few milliseconds.
Yes, and it's also in the nature of things that people who are trading shares for a few milliseconds are not interested in what the company is actually doing. All they're interested in is anticipating reactions by other people. And we end up, of course, with this absurd world in which we have computer algorithms trading with each other.
Absurd? Well, it is difficult to think of a better word for a financial system that's now dominated by computers trading with each other, firing buy and sell orders around the world at near the speed of light in a way that has little to do with an assessment of the value or worth of the companies in which they're trading so frantically. Absurd too, perhaps, that part of this trade involves racking up liabilities through derivatives that dwarf the size of the real economy many times over in a way so complex that even a maths genius couldn't unravel it. Next week, we'll be looking at another part of the world of derivatives that allows speculators to make fortunes betting on the price of the commodities our modern world depends on, and it means we all pay more for our fuel and food. Some believe that this has the makings of the next even bigger financial crisis. And remember who ultimately paid the bill for the last derivatives-fueled crash.
If this should lead to the kind of bubble we found in 2008, and there are serious losses as a result of this gambling, who's going to end up paying to sustain the banks? Well, the history was it was the taxpayers.
The reporter of How You Pay for the City was David Grossman. The programme was produced by Phil Kemp.